Hello everyone, welcome to LBS IAS Academy. Today we are going to discuss economics MCQs based on previous year UPSC questions. So let's start our session. Our first question is, with reference to the Indian economy, consider the following statements. Statements are, commercial paper is a short-term unsecured promissory note. That is correct. Certificate of deposit is a long-term instrument issued by the Reserve Bank of India to a corporation. That is incorrect. It's a short-term instrument. Call money is a short-term finance used for interbank transactions. That is correct. Zero coupon bonds are the interest-bearing short-term bonds issued by the scheduled commercial banks to corporations. That is incorrect. It's a non-interest-bearing short-term bonds. Which of the statement given above is or are correct? Here answer to this question is option C. Statement 1 and 3 are correct. The money market is the center for dealing mainly of short character. In monetary assets, it meets the short-term requirements of borrowers and provides liquidity or cash to the lenders. Call money, commercial paper and certificate of deposits are short-term financial instruments. Hence, statement 1 and 3 are correct and statement 2 is incorrect. Zero coupon bonds are non-interest bearing, non-transferable special government securities. Hence, statement 4 is incorrect. So, the answer to this question is option C. Next is with reference to foreign direct investment in India, which one of the following is considered as its major characteristic? Options are, it is the investment through capital instruments essentially in a listed company. That is incorrect. It can be in a listed as well as unlisted company. It's a largely non-debt creating capital flow. That is correct. It is an investment which involves debt servicing. That is incorrect. It is an investment made by foreign institutional investors in the government securities. Incorrect. So, the answer to this question is option D. It's a largely non-debt creating capital flow. Foreign direct investment is the investment through capital instruments by a person resident outside India in an unlisted Indian company or in 10% or more of the post-issue paid up equity capital on a fully diluted basis of a listed Indian company. FDIs are long-term investment. It is also non-debt creating capital flow as it has no direct repayment obligation for the residents. A foreign direct investment is an investment made by a firm or individual in one country into business interests located in another country. FDI lets an investor purchase a direct business interest in a foreign country. So, her answer to this question is option D. Next is the National Housing Bank NHB was set up in India as a wholly owned subsidiary of which one of the following? Options are SBI, RBI, ICICI Bank, LIC. Here answer to this question is option B, RBI. NHB is an All India financial institution set up in 1988. It's an apex agency established to operate as a principal agency to promote housing finance institutions both at local and regional levels and to provide financial and other support to such institutions. The NHB was previously an integral part of RBI until the Government of India purchased it in 2019 with the entire stake. This step by the Union was taken as per the Narasimha II Committee report of 2001. The NHB primarily raises the required funds from bonds, borrowings, debentures, etc. As per the Bank Regulation Act, the bond of NHB are accepted as security in the commercial bank that can be used to meet the statutory liquidity. So, here answer to this question is option B. Next is consider the following. Foreign currency convertible bonds, foreign institutional investment with certain conditions, global depository receipts, non-resident external deposits. Which of the above can be included in foreign direct investments? Here answer to this question is option A, 1, 2 and 3. That is FCCB, foreign institutional investment with certain conditions, GDR can be included under FDI. But non-resident external deposits cannot be included under FDI. FCCB, it's a bond issued by an Indian company in foreign currency and subscribed by a non-resident in foreign currency and convertible into ordinary shares of the issuing company either in whole or in part. Thus, FCCB included in FDI. In India, as per SEBI FPI Regulations 2019, a particular FII is allowed to invest up to 10% of the paid up capital of a company, which implies that any investment above 10% will be considered as FDI. GDR is also considered as FDI. But in non-resident external deposits, NRI investments that are repatriable are considered as FDI, while non-repatriable investments are considered as domestic investments. Hence, statement 4 is incorrect. Thus, answer to this question is option A. Next is consider the following statements. The effect of devaluation of a currency is that it necessarily, options are, improves the competitiveness of the domestic export in foreign market, increase the foreign value of domestic currency, improves the trade balance. Which of the statement above is or are correct? The answer to this question is option A. Statement 1 only is correct. Devaluation of a currency means a reduction in the value of a currency. When devaluation of a currency happens, exports become cheaper and more competitive to foreign buyers. Higher exports relative to imports can increase aggregate demand as it increases consumer spending on domestic goods and services. Hence, it improves the competitiveness of the domestic export in the foreign markets. Hence, statement 1 is correct. Devaluation occurs when a country intentionally reduces the value of its currency relative to one or more foreign countries. Hence, statement 2 is incorrect. Devaluation of currency increases the volume of exports and reduces the volume of imports, both of which have a favorable effect on balance of trade. That is, they will lower the trade deficit or increase the trade surplus. Hence, statement 3 is incorrect. So, here answer to this question is option A. Next is the money multiplier in an economy increases with which one of the following? Option A, increase in CRR in the banks, increase in SLR in the banks, increase in banking habit of the people, increase in population of the country. Here, answer to this question is option C, increase in banking habit of people. The multiplier effect is an economic term referring to the proportional amount of increase or decrease of final income that results from injection or withdrawal of capital. Increase in CRR, SLR and population of the country will not increase money multiplier. Increase in banking habit of the people can lead to increase in money multiplier in an economy. When a customer makes a deposit into a short-term deposit account, the banking institution can lend to one minus the reserve requirement to someone else, while the original depositor maintains ownership of their initial deposit. The fund created through lending are generated based on those funds. If a second borrower subsequently deposits funds received from lending institution, this raises value of money supply even though no additional physical currency actually exists to support the new amount. So, here answer to this question is option C. Next is with reference to urban cooperative banks in India, consider the following. Statement number 1. They are supervised and regulated by local boards set up by state governments. That is incorrect. Statement number 2. They can issue equity shares and preference shares. That is correct. Statement number 3. They were brought under purview of Banking Regulation Act 1949 through an amendment in 1966. That is correct. Which of the statement given above is or are correct? Here answer to this question is option B. Statement 2 and 3 are correct. Statement 1 is incorrect. The administrative functions of UCBs only comes under state government. The Urban Bank Department of RBI is vested with the responsibility of regulating and supervising of primary urban cooperative banks, which are popularly known as UCBs. Statement 2 is correct. With the prior approval of RBI, a cooperative bank can issue equity shares, preference shares, or special shares. Statement 3 is also correct. It's a factual statement. Large cooperative banks with paid up share capital and reserve of Rs 1 lakh were brought under the purview of Banking Regulation Act 1949 through an amendment in 1966. So, answer is option B. Next is Indian government bond yields are influenced by options are action of United States Federal Reserve, action of RBI, inflation and short-term interest rates. Select the correct answer using the codes given below. Here answer to this question is option D. 1, 2 and 3 are correct. Statement 1 is correct. Hiking interest rates in the US by United States Federal Reserve leads not only to an outflow of funds from equities into the US Treasury bonds, but also to an outflow of funds from emerging economies to the US. Thus, it impacts Indian government bond yields in negative manner. Statement 2 is correct. The multifaceted roles played by RBI in the payment system, monetary policy, financial stability policy, policy coordination with the Treasury gives it the operational ability to influence government bonds nominal yields. Statement 3 is also correct. Short-term interest rates and pace of inflation are the key drivers of interest rates on government bonds. So, Indian government bond yields are influenced by the monetary policies of RBI, the course of interest rates, the fiscal position of government and its borrowing program, global markets, economy and inflation. Hence, here answer to this question is option D,